Ladies and gentlemen, thank you very much for joining us, the Global Interdependence Center, can't even say my own name, here at beautiful Drapers Hall. My name is Michael Drury. I'm the Chief Economist of McVane Trading in Memphis, Tennessee, and the Vice Chair of Programs at GIC. We thank you for coming. This is our first venture into London, the heart of the financial district in Europe. We've been all over Europe, to Paris, Prague, Milan, Rome, Helsinki, Stockholm. We've done several. This is the first time that we ventured into the heart of the beast. We thank you for coming. This is we're going to be talking about monetary policy and currency issues, basically outside the euro area. We held a conference earlier this year in Paris that covered the continent. I'd like to particularly thank our sponsor, Strategas, who is represented here by Don Rissmiller and some folks at the back. Barclays, who's one of our annual sponsors here, and in particular Julian Callow, who is responsible for this beautiful hall and pointing us towards it. This is one of the most wonderful venues we've had. I hope it won't detract from the speeches, because I'll be staring at the ceiling most of the time. I would like to point out that there is a survey inside your booklet. Please don't lose it. Answer it and hand it in to Jill Fernito, the beautiful Jill Fernito here in the front. Our first panel is going to be on end of an era, questions about the end of QE in the United States. We're fortunate to have two representatives of the Federal Reserve System, Dave Altig, the head of research at the Federal Reserve Bank of Atlanta, and Danielle DiMartino Booth, a special advisor to President Richard Fisher at the Federal Reserve Bank of Dallas, followed by Catherine Mann, the Barbara and I can never get it right, Barbara and Richard Rosenberg professor at Brandeis University, and an MIT graduate with many of the top people at the Fed these days, and then Don Rissmiller, the chief economist of Strategas, who is our host. With no further ado, we'll let them up. They're each going to go about 20 minutes. Then we hope we have time for questions. When we get to the questions, we are filming, so if you could wait for the microphone to come before you ask your question so that we can get it all on tape, and therefore you can't deny that you asked what you asked. All right. We'll have the first panel come up, and we'll start with Dave Altig.
Well, good morning. It's a pleasure to be here. End of an era, that came with a question mark, the title of this particular panel. So I guess I have to answer something that has a question mark in it. So I'll give you my answer. Well, sort of, not really, maybe. I'm going to basically frame this in terms of QE, but we shouldn't really think of QE as one program. As everyone knows, there have been 3 QEs, and I'm going to frame my response to this question basically by arguing that the 3 QEs in the United States have in fact been very different. They're all generally cast in terms of this picture, which you've seen, which is the Federal Reserve's balance sheet. It's pretty big. The different colors here, because this is the asset side of our balance sheet, but you can describe the policy probably better in slightly different terms. Basically in terms of the liability side of our balance sheet. And that's been our policy for a while. Now, if I knew how to slow that thing down, I would, because obviously every month Spanky is throwing the dollars out the window a little bit slower and a little bit slower and a little bit slower. And by all accounts, it ought to end by the end of this year. Will that be the end of the era? And to that question, I'm going to say no, not really. And as I said, I want to think in terms of the previous QEs and contrast the current version of it to the other one. So QE1, QE2, QE3, I would describe almost in completely different terms, aimed at almost completely different ends. Not often described that way, so at this point I should probably say neither the previous picture nor these things is necessarily the views of the Federal Reserve. They're my own views on these things. I'm pretty sure Spanky throwing money out the window is not the official position of the Fed, although it's reasonably descriptive of the policy, I think. So QE1, I would cast as really the purest version of credit policy, of the asset purchase programs that the Fed has implemented since the crisis, particularly since about the end of 2008. QE2, I'm going to argue, was a completely, in many ways, different animal, and it was the one episode that I think we would really want to embrace, where we would really want to embrace the label of QE. And then I'm going to suggest a slightly different interpretation of the current large-scale asset purchase program, the one winding to an end now, QE3, in terms of a type of insurance for the policy that is really at the core of Federal Reserve policy today and will remain Federal Reserve policy going forward, what we all know as forward guidance. So let's do QE1 first. There's the environment of QE1, and this is a picture probably everyone's pretty familiar with. This is 30-day and 90-day LIBOR spreads over basically overnight rates, the OIS swap rate. And you can see the crisis pretty clearly emerge, and the only point here is to make the point that everyone knows that the first QE program, which we violently termed large-scale asset purchase program, despite everyone's desire to call it QE, was implemented in the midst of that. That's all pretty well understood. What I think is somewhat less understood is the reason that I think one of the reasons I think it is probably not really appropriate or correct to call it QE in the traditional sense. The balance sheet didn't really expand that much with the first QE program. The program itself involved the purchase of upwards towards $2 trillion worth of asset purchases, but the balance sheet itself of the Fed only expanded by about, less than $300 billion. That is, if you think of QE in its traditional sense, throw Spanky up to the window and keep pushing the cash out the window, expand reserves, expand the monetary base, increase the size of the balance sheet, QE1 did not really so much do that. And the reason is pretty obvious. This, again, is the picture of the balance sheet up to about the middle of 2010, where the different colors represent different assets owned by the Fed. And what you see is as we get into the QE1 program, the QE part, the red area, the green area to some extent, really only replaced lending that had been put in place with what we call the 13.3 facilities, the emergency lending facilities implemented throughout the back half of 2008 and into 2009. This was really the replacement of one set of credit policies with another set of credit policies, not a expansion of the balance sheet in the traditional QE sense, and that's the way in which I think that policy ought to be understood. It's a policy that is generally believed to have been fairly effective at influencing rates. So here's a couple selective studies of the effect of QE1. And what's interesting or important, I think, about these particular studies is the explanations for why it worked that is provided by these authors. So both Krishnamurthy and Vissing Jorgensen, which sort of looked at the Treasury purchase part, and Hancock and Passmore, which looked at the mortgage-backed security part, are very careful about making the distinction between QE1 and particularly in the Krishnamurthy and Vissing Jorgensen case, the effects of QE2, which were taken to be much more muted. And the reason that all of these authors suggest is precisely what I showed you before. QE1 was a credit policy implemented in the midst of a period when credit markets were still very, very dislocated and, in essence, segmented in a way that would make these sorts of interventions effective where they might not be effective in other circumstances. This was a crisis QE program, and as a crisis QE program, the type of assets we bought were important, had an effect, but there's some real question about how much these effects can be extrapolated both to the experience of QE2 and QE3, and I would argue that evidence subsequent to these studies on QE1 have shown that, in fact, this was the one that was very powerful in terms of directly affecting interest rates for reasons that I think we understand. They were interventions in a market that was under extreme duress. Not so much QE2, and QE2 looks like a QE program much more than QE1 did. So this is the monetary base, just another way to sort of look at the balance sheet in many ways. And there is sort of that observation I made before. If you look at the totality of QE1, there wasn't much of an expansion of the money supply. There was not much of an expansion of the balance sheet, despite the very much larger size of QE1 relative to QE2, which did, in essence, expand the balance sheet by the size of the program, about $600 billion, and not concentrated in any special sort of asset class. QE2 was plain old vanilla treasury purchases and looked like a plain old vanilla expansion of the reserves and the monetary base. And I think it's appropriate to think of that in terms of the economic conditions at the time. So here's a picture of inflation expectations. Inflation expectations measured by TIPS, measured by inflation swaps, and the demarcation of the important QE2 dates there at the very beginning. So if you look prior to that first vertical red line, the time when Chairman Bernanke stood up in front of a bunch of people at Jackson Hole and said, QE2 is a-comin'. You can see the circumstances that was confronting the Fed at the time. That is, expectations were falling and falling pretty dramatically, as were all real measurements of actual inflation. So we had drifting south inflation at the time. We had drifting inflation expectations that were, in fact, reversed as a result of not just QE2, but also the indication that QE2 was in the mix. Now, these are pretty volatile series, so you might say, well, not so clear that that isn't more than happenstance, since we've seen the sort of ups and downs in these measures since then, but there was another piece of evidence at the time that at least convinced us, sitting in the Atlanta Fed, that the event surrounding QE2 was much more dire in terms of the potential deflationary consequences than has been true subsequent to that event. And here's the picture. This is basically just deflation probabilities derived from options on TIPS. Because TIPS are basically a one-sided bet, you can use options to sort of back out the implied deflation probabilities out of market prices. And you can see what happened going into the summer of 2010 prior to QE2. Those deflation probabilities jumped. Now, we don't have a long time series on this sort of information, so it's hard to know exactly what to compare it to. But that looked unusual to us and looked somewhat frightening to us. So not only did we have actual measured inflation declining, inflation expectations declining, we had a measure of outright deflation probabilities that were accelerating and staying high, that were in fact subsequently reduced by QE2, never to return actually to those levels. Now this chart actually goes just through the beginning of last year, but we post these continuously at the Atlanta Fed website. You can go look them up. There are a whole bunch of different contracts, and they're basically hovering around zero anymore. This period, the period of QE2, was a period of what I think in the United States was a true deflation scare. And the response to that true deflation scare was a pretty traditional QE program, a la what we used to call QE when we talked about the Bank of Japan, and one that was effective at least in curtailing the sliding away expectations and fear of deflations that I think reasonably can be said to motivated policy at the time. Now, there's another important lesson out of this episode. So I've just blown up the area of the QE2 from that previous picture here. And here's what I took away watching that whole event at that time. The real change came not with QE2, the implementation, but rather QE2, the guidance about implementation. That is, the deflation scare effectively began to reverse and fade away at Chairman Bernanke's Jackson Hole speech, or following Chairman Bernanke's Jackson Hole speech. That is, watching this episode, one of the things that was striking was the fact that talking about policy, at least if everyone believes you're going to follow through, and in this case the Fed did follow through, is conducting policy. Not necessarily a new idea at the time, but one in which we saw a clear demonstration of the power of credible talk, which took us to the next sort of phase of policy, which is the seed of what I would call the new era, the so-called period of twist and shout. The twist part being the decision to concentrate Fed's asset purchases on the long end of the maturity structure, both in mortgage-backed securities and longer-dated treasuries, but also, importantly, the introduction for the first time of real, true forward guidance. Now, at the time, it was date contingent. That is, we said the interest rates are going to stay low at least until, well, mid-2013, maybe late 2014, and then mid-2015. A sort of imperfect an incomplete form of forward guidance in some ways, but the beginning of forward guidance itself. And this twist and shout period was obviously the clear predecessor of, with apologies to the ECB, the sort of twin pillar policy that is still in place today, although winding down as we wind down the asset purchase part of it. So the forward guidance, I would say, the date contingent part of it, the mid-2013, the late 2014, 2015 dates, were always stand-ins for economic conditions. Why were those dates chosen? Because at the time, the committee felt that those were the dates that would be consistent with economic conditions that would justify thinking about the raising of rates. Having changed that date several times, the decision was made that, well, isn't it just cleaner and more straightforward to appeal to economic conditions? And so the change was made in December of 2012 to introduce explicit unemployment thresholds and explicit references to the committee's inflation goals. Of course, we've become a little bit less explicit since then. But the policy of state contingency is still in place. So the LSAP, the QE part, is winding down. I'm just going to point out something that I think is worthy of note here. I have these conversations, and we have these conversations all the time with market participants about whether or not, when you think about QE programs, is it the stock that matters? Is it the total amount of purchase that you announce that matters? Or is it the flows that matter? Well, I don't know. We can still fight this, and a single picture isn't proof of anything. Causation and correlation are not exactly the same thing, of course. But I don't know. It still looks awful lot like a stock thing to me. That is the taper tantrum the effect of the end of QE3 really has not changed since it became clear that QE3 was going to end with Chairman Bernanke's testimony to Congress in the spring of 2013, the press conference that followed the June meeting. And since then, the arrival of taper has really had very little effect on market rates at all because I would argue the expectation is there. So why did it end? Why is it ending? Well, the standard explanation for why it's ending is it was always conditioned on improvement in labor market conditions. Improvement in labor market conditions has in fact come. The April report continues a long string of job creation in the U.S. in the neighborhood of 180,000 to 200,000 jobs per month on a year-over-year basis. That hasn't budged for 2.5 years, and the unemployment rate continues to improve. And there's some controversy about why, of course, but continues to improve nonetheless, consistently. So one explanation for why it was time to pull QE3 is simply that the conditions that it was meant to address have been met. There is a somewhat less universally adopted view, which was articulated by Mike Woodford, also at a Jackson Hole conference two summers ago in 2012. Woodford, long a proponent of forward guidance, of being explicit about how long interest rates are going to remain low and the conditions under which it will be time to change them, has made pretty clearly the following argument about LSAPs, about QE programs. A, QE programs clearly work when it's QE1. That in a condition where markets are segmented because of crisis or some other form of stress, going in and purchasing particular types of assets can very well be effective, and I think that's the story of QE1. Not so effective in and of themselves in more normal circumstances, which I would think would describe current circumstances, except for one possibility. And the possibility is that your forward guidance is not yet quite as credible as you would like it to be. That is, QE programs can be effective as the exclamation point on what your true policy is, which is a statement about your interest rates, how long they're going to remain low, and under what conditions they're going to increase. So another rationale, and not mutually exclusive rationale, for ending the QE program in the United States is that everyone more or less believes this now. That the job of convincing people, convincing markets that the interest rate policy is in place and will remain in place for some time is done. The exclamation point of the QE3 program is no longer necessary, and we can now revert to the core policy, which is talking about what policy is going to look like. So this is the sense in which I would say this is not the end of an era. The era we're in, I would claim, is not really about QE so much, but about the forward guidance bit. With this, we in many ways share a commonality with the Bank of England, the Bank of Canada, the European Central Bank. That policy of low interest rates is not yet close to ending, and therefore the era will live on at least for a little while longer. Thanks very much.
Good morning. Well, I should begin by saying what Dave said earlier, that these are my views and definitely not an official view of the Federal Reserve. I like to say sometimes my views are way off the reservation. And also, I'll throw out there that I'm not an economist by training, that I see the world through the prism of the financial markets. And that's how I advise President Fisher. So with that, we will start with this story that ran on the front page of the Wall Street Journal on April 20th. The article is titled, "Sluggish Recovery Proves Resilient." The good news, it reports, is that the current economic recovery, which started in June 2009, is about to celebrate its 5th birthday, stretching past the post-World War II average of 58 months. The not-so-good news is that the jobless rate, which is now 6.3%, it was 6.7% then, remains one of the highest on record at this stage of an expansion, while economic growth over the same period of 1.8% is half the pace of the past 3 recoveries. The article goes on to delve into the potential governors on growth. Is it higher taxes? Are onerous regulations to blame? What effect has greater uncertainty in its many forms had on growth? To be sure, all of these factors have had a hand in tempering the economic recovery. The obstacle that received no mention, however, in my view at least, was interest rates. Could it be that the root cause of the recovery's inability to achieve escape velocity is that interest rates have been too low for too long again? Now you may be wondering, how on earth can low interest rates be a bad thing? Well, I think the answer to that question has become increasingly apparent over the course of the last year, as the current easing cycle stretches into its 7th year. The most glaring example of financial markets distortion has manifested of late in the credit markets. Less obvious has been the behavior of the U.S. equity and real estate markets. Are any of these markets in what we call a true bubble? It's impossible to say. What can be said, however, is that the unwinding of similar levels of overvaluation has had a detrimental effect on economic activity in the past. Moreover, it's difficult to predict the full aftermath of the current easing campaign because of the additional tools that were deployed after rates hit the zero bound. Adding to the impossibility of forecasting the future is how very interconnected asset price behavior has become. I think it's almost disingenuous to discuss the credit markets and fail to link the effect record U.S. bond issuance has had on equities, as well as commercial and residential real estate. Still, it's always good to have a starting point, so let's begin with the credit markets. A colleague of mine recently forwarded me this chart that depicts something of a conundrum. You can easily see the dramatic decline we've witnessed of late in corporate borrowing costs. Our intuition tells us that interest expense as a percentage of gross domestic product should have also declined had firms been solely refinancing their existing debts at more attractive rates. And yet net interest paid ended last year at 1.9%, precisely where it was in 1980. The difference between then and now is that borrowing costs are about a third of what they were back then. Put differently, the last time interest rates were at today's level was in 1966, when interest expense was running at 0.9% of GDP, 1 full percentage point below today's levels. The missing link? Well, corporations did not stop issuing debt when the need to refinance debts was exhausted. Apparently, executives have moved past the 1990s, a period of relative prudence, and grown more comfortable with carrying heavier debt loads. At 55.2%, non-financial credit market debt stands at record levels. As for how firms are putting the proceeds from all of this excess debt to use, we'll get to that in a moment. One of the least appreciated outgrowths of the current credit cycle is how the composition of the bond market has changed. Not only was 2013 a banner year for issuance, when a record $1.5 trillion in corporate bonds were sold in the United States alone, this issue was led by the most speculative borrowers. By the time the year came to a close, a record 55% of outstanding U.S. corporate bonds carried speculative-grade credit ratings. 12 years ago, high-yield bonds only made up a quarter of the bond market. The overwhelming demand for assets with decent yields has not only pushed down the average rate at which high-yield firms can borrow. To that end, BB- rated firms were yielding just over 4% as of last week, the same rate at which investment-grade rated firms borrowed as recently as 2010. But the so-called dash for trash has also narrowed the difference between the borrowing cost of investment-grade rated and speculative-grade rated firms. Today, that spread, which you see on the screen, is 77 basis points, or tenths of a percentage point, the tightest level on record. The obvious question is whether the risk of investing in high-yield debt, which I will remind you is called junk for a reason, is being sufficiently rewarded. Consider that the same BB rated company that's borrowing today at 5% sports an 11% cumulative 5-year default rate. Slide down the credit scale to CCC rated credits, which comprise 12% of outstanding high-yield bonds, and you can expect to see almost half of the issuers default over the course of the next 5 years. Perhaps the most critical consideration emerged in a recently released report by Standard & Poor's, and that is that half of the $2.3 trillion in outstanding high-yield bonds has been issued in just the past 2 years. Is there a bubble in the credit markets? Forget for a moment that the spread between investment grade and high yield is at a record low, and dismiss if you'd like that issuance has also been running at a record pace. But if you do have an appreciation for history, you would be wise to place all of these factors against a backdrop of Treasury rates that are a full 2 percentage points below where they were in May 2007, at the peak of the last credit cycle. Maybe you can begin to appreciate how poorly investors are being compensated, again, for the risk that they're taking. I'll touch on one last red herring before moving on, and it's been in the media quite a bit of late, and that's corporate cash levels. The trillions of dollars of cash sitting on U.S. balance sheets have been regaled by the financial press. The catch is a huge percentage of the cash is quarantined in foreign domiciles for the purpose of avoiding stiff U.S. tax rates. Moreover, the bulk of this cash is concentrated among a handful of technology, pharmaceutical, and energy firms. Back out to how much cash U.S. firms have relative to the debt they've issued in recent years, and you can see that cash is actually sitting at a 15-year low. Much of the cash corporations have amassed, in other words, is due to the issuance of ever more debt. I'll offer you 2 takeaways as they pertain to the U.S. credit market. First, expectations for a huge resurgence in capital expenditures may be overly optimistic. Second, corporate America's vulnerability to recession has been amplified by this run-up that we've seen in debt levels. Consider for a moment that in the average recession, nominal profits declined by about 25%. If that happens, and borrowing costs increase to about 8% from today's 5% level, placing them on par with 2008, interest payments would jump to over 40% of pre-tax profits from the current level of 26%. Continued corporate profitability, and this is my bottom line when it comes to the credit markets, thus depends heavily on interest rates not normalizing. Now, the issue of profitability takes us to the equity markets, where things are not quite as overstretched as they are in credit, but frothy nevertheless. A recent study by Smithers found that the best gauge of the stock market's valuation is Tobin's Q, which is the ratio of the market value of all non-financial companies' stock to their net worth. Today, the Tobin's Q on the Standard & Poor's 500 is 106%, meaning investors are spending $106 to buy assets worth $100. The current level suggests stocks are about 70% overvalued. Now, many are quick to point out that this gauge is not as high as it was in 1929, when it was 135%, nor is it anywhere near where it was in 2000, when it hit 155%. Nevertheless, at least as gauged by Tobin's Q, stocks are trading at richer values than every other run-up we've seen since 1900, including 2007. Equity valuation viewed through a different prism, that of the size of the stock market compared to that of the U.S. economy, stands at 145% today. Stocks' aggregate value is thus higher than at any point save the peak of the NASDAQ bubble, when they were 174% of the economy. I get that stocks were poised to tack on an additional 2 years of gains in 1998. And I remember all too well that those on the sidelines paid dearly for their conservative posture. But those truths should not take away from the fact that 2000 did not end very well. To put things into perspective, from May 1996 through October 2002, the total return for U.S. stocks was on par with that of Treasury bills over the same period. Now, anecdotes also harken memories of the late 1990s. In the first quarter of this year, 71 companies came public in the United States, over double that of the first 3 months of 2013. But it's not just the volumes of IPOs that's striking. 3 out of 4 of these companies have had no profits to speak of. We also know that the small investor is emerging from a long hibernation. The 3 major retail brokers in the United States, TD Ameritrade, Charles Schwab, and E-Trade, reported trading volumes had increased by about a third in the first quarter. It should not be surprising, thus, that margin debt as a percentage of the economy is also approaching record levels. It sure feels like it's 1999 all over again. Perhaps the difference between then and now is that wage and salary growth is running at the slowest pace in the 32-year history of the data series. By the looks of things, retail investors are banking on stocks staging a repeat of the dot-com era. Is it likely that that's the case? It is possible for reasons that we'll get to shortly. But caveat emptor, judging from past experience, history's never on the little guy's side. Of course, there's no denying corporate profits have staged a dramatic rebound of their own in recent years. That's not to say they haven't had a captive source of major support. Some estimates suggest that up to a third of profit growth since the onset of the current easing campaign is attributable to a decline in interest expenses. That's easy enough to see. But there's a much less obvious and much more powerful source of support under stock prices. Picture this. You're the CEO of a publicly traded company on New Year's Eve 2012. Shortly after the hangover wears off, your treasurer informs you that your balance sheet is bulletproof. You've refinanced all of your debt at rates closer to where Treasury bills were just a few years ago. So what do? Do you call your friendly neighborhood investment banker and thank him or her for their great work and tell them you'll catch up with them in a few years' time when all this cheap debt has to be refinanced? Do you take a break from the debt markets? Not by the looks of this screen. You don't abandon the debt markets, you embrace them. You pay yourself a special one-time dividend, or even better, issue debt to buy back shares, and in doing so, reduce your float. And voila, your earnings grow even more. Since 2005, companies have repurchased $4.2 trillion of their own stock. That comes out to nearly 1/5 of the total value of U.S. stocks today. It's no wonder the performance of the stock market, the blue line, has become increasingly tethered to buyback volumes. Now, if you think that this game played by companies who have, if you think that this is a game played by companies who have to manipulate their bottom lines, think again. Buried beneath the exciting news that Apple was going to execute a reverse 7-for-1 stock split and increase its dividend to $11 billion a year was some very fine print. Follow this simple math with me. Apple generates between $11 and $13 billion in domestic cash in a given year. That obviously covers the dividend and leaves a wee bit of change. But that extra billion or so won't make a dent in its $90 billion share buyback program. Stay with me here. Because 88% of the tech giant's cash pile is overseas, Apple will have to issue record levels of debt to finance the buyback. They did just that last week in the third largest investment-grade bond offering in history. Don't get me wrong, the $130 billion in cash held overseas is real. It's just not capable of boosting the share price in the here and now. So step back for a moment and ponder the economic effect of financial engineering, because that's a major engine powering the U.S. economy. As for real estate, easy monetary policy has also had an enormous impact, at least on the commercial side, where prices have risen by 85% since troughing, nearly recapturing their pre-crisis peak. That contrasts sharply with residential real estate, where prices are only 39% off their lows. Investors have begun to voice concern that they're an unwilling accessory being forced to chase commercial real estate prices to unsustainable levels yet again. But they're in a tough spot given the huge influx of fresh funds to the sector, funds they're mandated to deploy. Issuance is up 7% over last year. Demand for deals, however, continues to bury the available supply. This demand-supply imbalance is increasingly apparent in valuations. Pricing in commercial real estate is quoted in terms of cap rates, which you can think of as the rate of return on a property based on the income it's expected to generate. Over the past year, they've fallen dramatically. Office property cap rates are a mere half percentage point above their June 2007 lows, while the multifamily cap rates are at the lowest on records. Apartments, in other words, are selling at the steepest valuations on record. What's to come for home prices? Well, a lot depends on whether the two movements triggered by the housing crash persist. Will the homeownership rate continue to decline? Will the rental revolution carry on? One thing is for sure, we're in uncharted territory. Over the past 10 years, the growth of homeowners has declined, while the growth of renters has been that mirror image, and it's expanded dramatically. I would argue that until this tug of war ends, the one between the haves, the all-cash buyers, and the have-nots, the first-time home buyer, we won't see much in the way of stronger home sales. That's the problem with what I like to call price-agnostic buyers, those who are wholly insensitive to home prices because they're spending someone else's money. These armies of investors are largely responsible for the home price gains we've seen for 25 consecutive months. The good news is that after hitting a low of 26% in January, the ranks of first-time homebuyers rose in both February and March to 30%. That said, all cash buyers continue to outpace first-timers. They accounted for a third of sales in March. Stepping back, there are two prerequisites to freeing many baby boomers' children from their parents' basement. Either apartment rental rates decline or home prices fall enough for first-timers to allow first-timers their first foot in the door. Until that happens, I don't think we'll see household formation pick up off its lows. It's hard to imagine, but household formation in the United States was 449,000 last year, far lower than the 1.35 million average from 2001 to 2006. These figures have continued to confound the analyst community. Of course, there are tangible benefits to the tremendous inflation we've seen in asset prices. If household net worth is the correct gauge to measure the success of current policy, I'd say we've more than hit the mark. So far, $25.1 trillion in net worth has been generated, a figure that eclipses even the housing boom in magnitude. So net worth has retaken its record high. This would be even better news if American households today weren't shouldered with just as much debt. Don't get me wrong, mortgage debt remains well off its peak, but mortgage deleveraging has been more than offset by increases in credit card and auto loans and student debt to finance the higher educations many workers were hoping would allow them to weather the recession storm. Exactly how does today's experience depart from prior episodes? I suppose it's the very unconventional aspect of the current easing campaign. It's plain to see that interest rates have been trending down since 1982. As for the economy, it's dutifully responded time after time with greater output. That is until this last cycle when you can see economic output, the blue shaded area, declined off the trend line. So we've had sluggish economic growth in exchange for a $4 trillion and counting balance sheet as the Fed continues to purchase treasuries and mortgages, albeit at a tapering pace. As for the fruits of these purchases, a colleague of mine recently ran some numbers comparing the growth of the Fed's balance sheet to that of the labor market over the last year. In 2013, average monthly payroll gains were 194,000, 8,000 more than 2012's average gains. In other words, $1 trillion of quantitative easing generated an additional 96,000 jobs last year. That works out to about $10.5 million per job. So bear with me because there's a twist in terms of how Fed policy and the tapering can be efficacious at this juncture in a market cycle. Well, as for what's to come, we know companies authorized an additional $197 billion of share buybacks in the first quarter. This year is on pace with the other two record setters, 2007 and 2013. But there are signs that the appetite for buybacks could be waning. That's not to say companies have tired of issuing debt to grow their earnings. They've just shifted their focus. In the 78 days through April 24th, a grand total of 131 mergers and acquisitions deals totaling $1.2 trillion were announced globally. One analyst likened the rush to pursue debt for equity acquisitions as a different form of financial engineering, calling it the Botoxing of stocks. Are companies making rational decisions? Maybe the aggressive acquirers know that interest rates have been so low for so long that a separate force has emerged, one that's working counter to the Fed's current efforts to begin the process of normalizing interest rates. And with that, I refer to pensions, specifically public pensions, half of which reduced their rate of return assumption in the past 2 years. Why do such a thing when the stock market has done such heavy lifting since 2009? The answer to that question is equity returns are but one of the many drivers of the asset allocation process. Expected bond returns play a much more prominent role given the fundamental purpose of pensions, that is to match assets to future liabilities, which are necessarily long-term in nature. Now, I apologize if I'm digging too far into the weeds, but please bear with me. Each and every pension that reduces its rate of return assumption to reflect the reality of persistently low interest rates is obligated to write a check, to infuse the pension with cash to ensure that adequate funds are available as the number of pensioner checks written in the coming years grows as baby boomers hit retirement age. But here's the key, and it relates directly to demographics and perceived risk controls. Pensions are increasing their exposure to fixed income to pair their exposure to the stock market, and in doing so, diversify their portfolio, thus better matching the expected returns of the pension to its liabilities. There quickly is just a sampling of, of some pension allocations made over a 2-week period this past April. Now, bear in mind, private equity, real estate, and buyout funds are all proxies for fixed income. The money raised and deployed feeds directly into the credit markets, propelling this loop you can see on the screen into motion. So it starts with pensions selling equities and reducing their rate of return assumptions, and I should add, increasing life expectancy estimates. All three of these actions add fuel to the fire under the credit markets, which gains momentum as it funds share buybacks and M&A activity, both of which boost earnings per share by reducing share count, and in doing so send stock prices higher, necessitating a further pairing by pensions to their exposure to stock, and so on and so on. Hence the term bullish for bearish regions. Can policy do enough at this point to slow the feedback loop? Recall what I said earlier, that only half of U.S. public pensions have reduced their rate of return assumptions. I'd bet that the actuaries will eventually prevail in compelling the remaining pensions to follow suit. Quantitative easing may endeavor to revive animal spirits by making debt so cheap for so long that it's impossible to not play along. But nearly 30 years later, in the wake of one speculative boom and subsequent collapse after another, I'm afraid to say that we haven't learned near enough. It's not the creation of debt that makes a lasting impact on economic prosperity. It's investment in the future that promises to retain its value for generations to come. I'll leave you with the following words written earlier this week by David Zervos, who spent much of his career at the Fed but now works as chief strategist at Jefferies & Company, a non-bank broker doing a brisk business in both equity and credit markets. Dave, by the way, is adored as the street's most enthusiastic stock market bull and argued eloquently in favor of continued QE at Mr. Altick's conference just a few weeks ago. And I'll leave you with this quote. The most interesting question centers upon where the next leverage bubble will come from. The jury is out, but my guess is that with financial regulation on the rise, it will not come from banks and fund managers. It will not come from structured products, repo, or securitization. Those were the seeds of the last crisis. Instead, the leverage will enter through corporate balance sheets, a place where regulators are not focused today. As the developed market economies continue down the path of a reflationary recovery, corporates will continue to buy back equity, engage in leveraged buyouts, increase M&A activity, and generally speaking, increase operating leverage. The next bubble will come from confident corporates who have excessive quantities of cash on their balance sheet. As soon as the household balance sheet comes to life, which it hasn't yet, these corporates will lever themselves like a couple of Nobel laureate finance professors turned hedge fund managers in Greenwich, Connecticut. Risk assets are heading into the next phase of the recovery period, the euphoria phase. Meet the new bubble, same as the old bubble, and welcome back to the 90s. Good luck trading. Thank you.
Well, I'm really delighted to be here to be talking with my former colleagues from the Federal Reserve. I spent many years there in the International Finance Division at the Federal Reserve Board in Washington before I decided to become an academic for a while. So my perspective is going to be looking at quite a bit of the international aspect of this question. And of course, in keeping with what the Federal Reserve is supposed to do, is it's supposed to take the punch bowl away when it's time for the party to end. And so my question is the party over? And should they be taking the punch bowl away? So one aspect is to sort of say, yeah, you know, it's really been a great party, but you know, it's time to clean up and time to go to bed, wake up, have a new day, do your work, and then go on. Or the question is, it's time to weaken the punch because the hosts are tired. And, you know, some of the guests are getting a little unruly. So I'm first going to look at the standard macroeconomic indicators that the Federal Reserve and the FOMC have put out for themselves to evaluate whether or not it is time to either weaken the punch, which is, of course, what they are doing, or to take the punch bowl away. So the three measures of macroeconomic performance that they have put forward as being these metrics that we ought to be looking at are, of course, inflation, GDP, and unemployment. When I was at the Federal Reserve, we kind of all packaged that up with the concept of sustained non-inflationary growth. And we didn't kind of try to parse out which one of the three we were really going to focus on at any period of time, because from the standpoint of the pre-forward guidance phase, where we tried to tell everybody exactly what we were going to do, we were kind of in the discretionary phase of policymaking, which was sustained non-inflationary growth encapsulates inflation, unemployment, and GDP growth. And of course, the weights on those three necessarily do change over time. But this FOMC doesn't do that. They have given explicit thresholds, targets, whatever you want to call them, for each one of these three, and they've presented us with their forecasts, or their projections, their projections. And so this is the example of the central tendency of the FOMC members and all the bank presidents as well, whether they are actually serving on the FOMC at that moment of time or not. These are, of course, in the projections, additional materials that come out 4 times a year. So what I've done here is give you the blue lines, which are the central tendency of the FOMC and bank presidents as they were made at the December 12 FOMC, and then up to the most recent one in March. The blue lines are the ones that were made for for inflation, or actually, you know, the PCE measure of inflation, for 2013, and the circle at the end is where we actually ended up with inflation, measured as PCE, in December of last year. The red lines are the central tendency for the projections for inflation in 2014, the end of 2014. They are done for the end of each year. And the circle is where we are as of March 14th. So if we think that the objective of Federal Reserve policy is to achieve the center of those center lines, of those two lines, you know, they were pretty close in terms of the 2013 end of year, but we're a long way away from where they think inflation ought to be for 2014. And moreover, they're a long way away from the 2% explicit inflation threshold or target. I think they actually call it a target. Other things are a threshold, but the inflation target, they're a long way away from the 2% inflation target. So based on this particular measure, is it time to weaken the punch? No. It's not based on PCE. Now, there are mixed views in the market on whether or not inflation is on the horizon. A variety of people tend to look at wages and believe that there are pressures in the wage market, some commodity prices. So there are mixed views on whether or not inflation is coming, and therefore, weakening the punch or taking away the bowl is the appropriate strategy for the FOMC. But based on the measures that they have put forward for us and based on their projections, the answer is no. So what about unemployment? Is it the second threshold that has been explicitly set out there as the objective of the monetary policy strategy? Is it time to weaken the punch? Again, this is the structure of the central tendencies. The blue lines were what the projections were for 2013 based on the FOMC dates. And then the red is the central tendency for the forecasts for the end of 2014. The circles are where we were at the end of December 2013, and then the 6.3, of course, is the one that was just released. So based on unemployment, which I always would say was the sort of the outcome of the policy as opposed to a target of the policy. Many people would suggest that the Monetary Policy Authority really should be focusing on maybe inflation only, as they do as the ECB. You guys have a sort of a dual mandate. Of course, we have a dual mandate as well. So, but based on this measure, yeah, time to take away the bowl. Based on where we were at the end of last year, performing better than our threshold objectives. And this year, really very close to where we'd like it to be by the end of the year. We're already there, practically. We're already there. So based on the headline numbers for unemployment, yeah, take away the bowl. But of course, there has been for an extended period of time, all of last year basically, a backing away from the headline number as representative of the type of labor market performance that would warrant a taking away of the bowl. The extended duration, the high percentage of the of the unemployed who are still unemployed for more than 27 weeks, the inability of that group to find jobs, and then the declining labor force participation rate as well. These two measures are viewed as a reason for taking the headline numbers and saying, well, we're not really happy with those headline numbers, and so we're not going to actually change our policy strategy yet. Based on the headline numbers, we should, but we don't think those headline numbers actually represent the kind of labor force performance that we really want to have, and so we're kind of telling you, don't actually pay attention to the number that we said you should pay attention to. This creates challenges for forward guidance. This is why I'm bringing these things up, because if that's the strategy that the Federal Reserve and the FOMC are explicitly going to use going forward, then either you tell the market exactly what you really mean, or you really don't tell them very much at all, in my view anyway. Sustained non-inflationary growth would be a perfectly fine way of giving forward guidance if what actually you're going to do is give them some target numbers and then say, but no, not really. So the third explicit measure put forward in the projections, of course, is GDP. Based on GDP as a time to weaken the punch. Last year, in the annual growth rate for the year was 1.9, which was well below what the central tendency had hoped for in terms of its projections. But Q4 was very good, was above the central tendency at 2.6%. Now, of course, Q1 here is a long, I didn't even put it on the graph because, of course, it would have changed the whole scale. Q1 for 2014 has been really very, very poor. It's generally viewed that the revisions to Q1 data, when they come out, will push the Q1 number into negative territory. So, based on if we had sort of not gotten Q4 data, Q1 data yet, there would have been an argument, yeah, it's time to weaken the punch, it's time to move along, maybe not take away the bull yet, but definitely weaken the punch. Based on the Q1 numbers coming out, I think that this question is a little bit more unclear. So I want to talk some more. I want to get into monetary policy as opposed to just what it is that the FOMC said they wanted to see in terms of their projections. And in order to talk about some of the concerns I have about the monetary policy stance, because up to now, you might have thought, okay, she says we should just keep on partying. Leave the party, leave the punch, leave the bowl, maybe even spike it up a little bit more, as opposed to weaken it through the tapering process. But that's not actually where I'm going to end up, and it'll take me a minute or two to get there. So I want to look at the decomposition of GDP, because I believe that this decomposition of GDP is going to give us some insights into why indeed it's time to weaken the punch, because the hosts are tired and because some of the guests are unruly. So these kinds of decompositions I find useful in order to set the stage for looking at how the global context can help us understand something about prospects for domestic performance. So we have the decompositions of GDP, which is in the black dots, into the major components, the C, I, G, X, and M components. I'm going to focus on actually each one of them, but for different reasons. So let's first look at the pale blue, that's personal consumption expenditures. Looks pretty good, improvement in 2014. Q1 been a major component in 13. Although exports, which is in the green, has been relatively more important for expanding GDP growth through to 13, particularly poor performance in 2014. We're going to look at that in more detail because prospects for global growth is an important contributor to whether or not we think that 2014 is going to get us to the 3% growth that is the part of the central tendency and would warrant a continued taking away of the bowl by the end of into 2015. So the other one piece of the component that I want you to focus on is the relationship between personal consumption expenditures in the light blue and imports in the hashed red. So usually, based on historical data, that has been one of the most persistent relationships that we have in international real-side relationships, is that if personal consumption expenditures grows by, say, 2%, imports should grow by 4%, or maybe 5%, or even 6%. So in other words, there's usually a 2-to-1 relationship between what we observe in PCE and in GDP more generally, and in import growth. And now this is something that has completely broken down since 2011. And that has ramifications for not only just the statistics, but also for global growth prospects. The last component in here that is relevant is the dark blue. The dark blue is business fixed investment, or now it's got new names. It's equipment, software, and intellectual property. I am not looking at structures here. So for those of you who want to do the numbers, it is not structures. That's a completely different category. I think it's interesting, but I don't think it's interesting to look at from the standpoint of international. So as you can see, usually business equipment, intellectual property is an important driver of economic activity. It is also very important as an underpinning of that sustained non-inflationary growth. It's where the Y potential comes from, and it's been very weak. So, taking those two pieces that I wanted you to focus on, one, is exports going to continue to power GDP growth and help us achieve our 3% target, or 3% objective in the central tendency for 2014, setting the stage for a complete taking away of the bowl? I don't think so. Exports are a window on the world. And looking at this structure, this is the decomposition of export growth, which is in the dark circles, into the main components of what it is that we sell to the world. And the answer is that the biggest components of what we sell to the world, which is capital goods in the dark, in the solid yellow, and business services and intellectual property, which is in the light blue. These are not healthy components of exports. They are not driving our export growth. In fact, they are weakening. And as a window into the growth of the rest of the world, it basically is telling us that the growth in the rest of the world is weak. It's not turning up. And so if the exports, if the rest of the world is continuing on a really pretty modest growth path, then we cannot depend on our major exports, export components, to drive us forward on the domestic side, thus allowing our monetary policy authorities to take away the bull. Now, imports are a window on domestic demand. And this, again, decomposition basically tells us that the main drivers of imports are the components of consumer imports, which is the dark blue, and capital goods, which again is the solid yellow. Now, on the consumer side, if I was a retailer and I thought that the U.S. consumer was going to be a sustained coming into my store, taking stuff off the shelves, then I would be importing that now. And as you can see in 2014 Q1, it's negative. There was a little bit of a revision for the March trade data, but basically the retailers to the U.S. consumer does not see the U.S. consumer as being a healthy, pocketbook wide open, partying on kind of group. And so that, I think, is an important window into prospects for the consumer to continue to be a sustained driver of domestic economic activity. I'm not saying that they're going to fall off the log, but I don't think that we can continue to expect the consumer to be a very lively contributor to that GDP growth, and probably is not going to be not going to help us as an overall economy to get to that 3% 2014 average growth. Now, the second, there's the, where is the yellow as we look at 2014? It's not there. There's no capital investment coming into the U.S. economy. That matches the very, very narrow slice of dark blue in GDP. Business also does not think that 2014 is going to be a robust year, because if they did, they would be bringing in the equipment now in order to marry it with domestic resources to generate greater capital expenditures, thus supporting greater job creation and income creation for the economy. So if business doesn't think 2014 is going to be a great year, and consumer retailers doesn't think it's going to be a great year, then it's really hard to think it's going to be a great year. Okay. So is it time to weaken the punch? Based on our traditional macroeconomic metrics of inflation, GDP, and unemployment, probably not. So where would we go to look if we think that, in fact, it makes sense to weaken the punch to continuing the taper and ultimately take away the bull? What I've done is to look at what Chairman Bernanke said in his Jackson Hole speech of 2012, monetary policy since the onset of the crisis. Most of that was on the benefits of monetary policy, but at the end he did put out a framework for thinking about the costs. And he set up these set of issues to consider: that there will be a loss on balance sheet assets, inability to exit smoothly, financial fragility from search for yield, and disruptions to the U.S. Treasury market. I've added unintended consequences of QE. Now, I'm not obviously going to focus on all of these, but I'm going to focus on unintended consequences of QE and disruptions to the U.S. Treasury market. So in terms of unintended or intended consequences of QE, Danielle already talked to us a lot about the equity market. I agree with everything that she said. This appreciation or increase in equity assets is related to QE. Here's a picture from stockmarkets.com of the S&P. But that the underpinnings of this asset appreciation is not from revenue generation and expansion of sales. Those earnings that support what we see here is the stock buybacks, the very, very tight labor expense, and so forth. What I'd like to focus on is that there is a tremendous disconnect between the asset market appreciation and the real economy. This disconnect is an unintended consequence of QE. So we've already seen on the business side, we have this tremendous increase in equity valuations, but it's not showing up at all in terms of CapEx. So that's the first disconnect. It's showing up instead in these other ways of using our financial assets. In addition, an unintended consequence and a disconnect between asset markets and the real economy is on the consumer side. We've had a tremendous appreciation of the asset market. That is exactly the asset channel. In some sense, it's exactly what quantitative easing is supposed to do. But if 95% of all of the financial equity is owned by the top 10%, and in fact 42% owned by the top 1% by income, this concentration of financial wealth implies a concentration of financial capital gains. And so if we thought that the equity appreciation was going to generate the consumer gains, the answer is no, because of the concentration of those gains in a limited part of the population. And so we observe that, or I observe that, in terms of very sluggish consumption, especially on imports of consumer goods. Now, let me talk about U.S. Treasury markets and quantitative easing. Here's a picture of who holds U.S. Treasury securities. It's the public in blue, it's the foreigners in green, and it is in the Federal Reserve in red. I would argue that the hosts of the party, of course that's the Federal Reserve, are tired because they have a rising share of the total market, and they've been taking the share away from the foreigners. Now, it is an unintended consequence of the quantitative easing, set of quantitative easings. This is a picture from my friend Torsten Slok at Deutsche Bank. It's an unintended consequence, although of course it's what you had to do, that the Fed's share of long-term assets, of owning long-term treasuries, is almost 50%. Now, in some sense, the foreigners don't really seem to care that the part of the portfolio of U.S. Treasuries that they get to hold, that's available out there. They don't really seem to care too much that the share available to them has been declining. On the foreign official side, 70% of the foreign official portfolio is U.S. Treasuries. So they should care that they shouldn't be, not available to them. So in fact, if you look at the foreign, at the margin over the year, the flow of U.S. Treasuries going to different buyers, the red is the Federal Reserve, and you can see the expansion of the balance sheet in 2011, and then again in 2013. The Fed was buying more than foreigners, the green, and in 2013, the foreign official buyer was completely out of the market. They were not, they didn't buy. They didn't buy. So the hosts are crowding out the guests. Now, In terms of the unruly guests at the party, I've already said that the asset markets in general are sort of unruly guests at the party, but I want to focus on another group that are unruly guests at the party and would warrant taking away the bowl, or at least weakening the punch. This is a picture of cross-border purchases and sales of long-term U.S. Treasuries. It's monthly data. I've smoothed it in the dark line. Going back to 2013, the quantitative easing programs are shown in the red during the various QE1s, the QE2, the twist, and then QE3, and also taper talk being noted in terms of the dates. When people talk about foreign purchases of U.S. Treasuries, they tend to focus on China and Japan and sort of look at whether or not, what are they doing? Are they buying? Are they not buying? And this is the most important determinant of what's going on in the U.S. Treasury market, at least taking the foreign perspective. The two little lines at the bottom in red and blue are the cross-border purchases and sales by China and Japan. They don't play any role in this picture whatsoever. Instead, you've got the trading financial centers, the euro area in light blue, which is basically mostly coming through France. You've got the dark purple, which is the CFCs, Caribbean financial centers, and then the green, you guys, in the UK. What's driving cross-border purchases and sales on a monthly basis, which is running at about, at this point, about $3.5 to $4 trillion a month, that's on a monthly basis, not on an annual basis, is what traders are deciding what to do with their U.S. Treasuries. And of course, the CFCs are what U.S. residents are deciding what to do with their U.S. Treasuries as they channel it through the tax-advantaged jurisdiction. So these guests are unruly in the sense that they are playing off of the forward guidance that the Federal Reserve is providing to them. And when we think about volatility in U.S. Treasury yields as it changes over time, it's what's going on with these cross-border purchases and sales, not what's happening through the traditional holders, which is the Chinese and the Japanese. So is it time to weaken the punch? Not based on traditional macro objectives, but the hosts are getting tired. We already saw the size of the balance sheet. We saw their concentration in the long-term U.S. Treasury maturities, owning almost 50% of long-term debt. They're crowding out of foreign demand, especially of central banks, who have been important determinants in the previous periods of underpinning low long-term interest rates. Also, there are some unruly guests in terms of the asset channel, the disconnect between the assets and the real economy, and of course, these cross-border traders. So, weaken the punch, leave the bowl. Thank you.
Thank you very much. It's great to follow those talks by David, Danielle, and Catherine. I'm going to make some comments. I'll keep them abbreviated because what we're going to do next is bring the whole panel back up and take questions from the audience. But I wanted to also address this issue about whether it's the end of an era, starting with the idea that it seems the central bank and many central banks may be in an opposite position to where they were 5 years ago, meaning 5 years ago, the job of the central bank was conceptually simple, which was you had to ease a lot. You know, in a crisis, you ease a lot. It was technically very hard. So a lot of people spent late nights coming up with new acronyms. So CPFF, MMMF, TALF, TARP, TAF, and so on, because the plumbing was broken. And so today, it seems like there's the inverse of that, meaning it is technically much easier to tighten. There's the interest rate on excess reserves, there are reverse repo facilities, there are ways to tighten. You could tighten tomorrow if you wanted to. So it's technically easy, but it's conceptually very difficult. It's conceptually very difficult to know when to make that move, and the example of Japan brings that into question. And so part of what we have, I want to argue, is an anchoring problem, which is we've been at zero for a very long time, and so we're getting used to it. After the shock, many central banks have been at or close to the zero bound on interest rates. This has happened around the world, and it's starting to attract interest from the academic community, from the financial community, in terms of how long we're where we are. So if you look at the Fed funds rate, this is odd on both the X and the Y axis. So we know it's low. So if we look at where we are, we're at the bound on the Y axis. But it's also odd on the X axis, meaning we've been here for quite some time. In fact, we're at a level for a period of time that we usually don't see. You usually don't see the Fed funds rate stay any level for this period of time. So it's the oddity on both the X and the Y axis that is starting to attract interest. And so where is this going? I want to say that we're starting to try to figure out what is the disease. What is causing this zero bound condition to persist? And so it looks like central banks are trying to make up in time what they can't do in magnitude, because the zero bound is real. And I would argue that's real because you always have a security cash that will pay you zero. You have to try and use other tools, and we talked about quantitative easing and forward guidance, et cetera. But the problem is the credibility of these tools. And so we've tried to reinforce this low for long commitment. The Financial Times recently ran a contest to see who could come up with the best description of forward guidance, and President Fisher's talked about this. The winning entry was basically "we'll see" as the shortest and most accurate description of forward guidance. And so let's take a step back and think about where we're at. Bill Poole once said that an equilibrium is the Fed behaving the way the market expects and the market behaving the way the Fed expects. When you have both of those happening, you'd say you're in an economic equilibrium. The problem with this right now is it seems both sides are hypersensitive. So if we look at the Fed statement, it says that the Fed's watching unemployment, it says the Fed's watching labor market conditions, you're talking about watching inflation and watching inflation expectations. And then there's this other item, financial developments, that keeps getting mentioned. And what we've seen over the last several years is the Fed become hypersensitive to the market. For instance, last year when mortgage rates went up, that became a big deal. On the other side, it looks like the market's hypersensitive to the Fed. So I would argue the market reaction to Janet Yellen's 6-month comment when she was asked, once QE ends, how long after that might it be before the Fed funds rate goes up? And she said, 6 months or that type of thing. And that got a big rise out of the market. That seems like a hypersensitive condition. That seems like you have the Fed hypersensitive to the market and the market hypersensitive to the Fed. So could these be related? Are we hypersensitive because of this zero bound condition? Part of what I want to highlight is that there are several main central bank tools, and perhaps we're tasking the central bank with too much. The problem is all of these tools look exhausted. So the main central bank tools will be the interest rate, balance sheet, and then talking, forward guidance. Interest rates, we said, are zero. The balance sheet we've talked about as a tool which looks like it's getting exhausted. It doesn't look like we want to do more QE indefinitely. And forward guidance, I would argue, is highly nonlinear in credibility, meaning if you say you're going to do something for a year, maybe the market believes you. If you say you're going to do something for 2 years, it's pretty iffy. And if you say you are going to do something for 3 years, I'm pretty sure nobody believes you at that time horizon. So I'd say it's very nonlinear in credibility because error functions become nonlinear at those type of time horizons. And given that forward guidance has been issued for more or less the next year, that 6-month comment after the end of tapering, it looks like you've exhausted all of your central bank tools. Interest rates are zero, QE is exhausted, and even forward guidance here will be tough to extend from where it is right now. And so in medical language, what I think we're searching for is who is patient zero? What is the root cause? Who is the first case that has spread this ZIRP, zero interest rate policy, around the globe? Well, there's certainly a very large shock. That's part of it. It may be related to the interaction between policies. We'd count 4 main government policies that you want to think about. One of them is monetary policy. We could think about fiscal policy, trade policy, and regulatory policy also being involved here. And perhaps there's an interaction effect that we have to consider between those. But where I want to go at this moment is to the inflation target. And I think there's a developing line of research that's gone on now for a number of years that perhaps patient zero is the inflation target itself. Maybe the 2% is not right, and maybe the 2% is too low. So what does that mean? It means that if you start with an inflation target that's too low, you're never able to give the economy a big enough kick. So if you have a 2% inflation target and you cut rates to zero, you'd be looking at a minus 2% real interest rate. If instead you had started with a 4% inflation target and you cut rates to zero, maybe you get a bigger kick. In other words, maybe there was an argument historically for starting with a higher inflation target, given that we now have so many central banks stuck at the zero bound. Nonetheless, we're stuck with 2, and I think 2 has prevailed, and so we have to deal with the aftermath of those consequences. So it looks to me like we're going to remain hypersensitive to financial developments. In other words, part of starting with a low inflation target, succeeding in getting inflation there, actually succeeding perhaps too well in getting inflation there, has meant that now financial conditions matter to the central bank more than they might have in the past. And so I would look at it, I would look at the data and say it looks like a tightening is coming. It's a question of who's going to do it. Will it be the Federal Reserve in the U.S., or will it be the market that does the tightening first? Or part of having very low inflation with central banks that want inflation higher is you could have more inflation scares in this environment, even if you never succeed in getting inflation. And so where would this come from today? This is a chart of average hourly earnings for production workers. So this series has a long history. There's another version of this series which includes supervisory workers. It has a shorter history. So I prefer this one because you get to see what happened in prior cycles. So the shaded bars here are the recessions. And what you see is there's a pretty distinct business cycle pattern to wage growth, which is wage growth slows early in a business cycle as unemployment's high, and wage growth turns around in the middle of the cycle. Once it turns, it tends to keep going. In the last 3 cycles, you've gotten to about 4% before you've started to generate the conditions that would suggest you're getting late in the business cycle. When you hit 4% in average hourly earnings, if you take an average of prior cycles, about 2 months after that profit margins peak and a little over 2 years after that, you get the next recession. So I think this is an interesting series. It's not completely representative, but I think the momentum in this series is very important. In other words, it's pretty smooth. Once it turns, you can be pretty confident you're in the second half of the business cycle. You're in the maturing part of the business cycle. And so that's what we've seen today. Now, we're not growing quickly. We are gone from 1% to 2%. So we're not at that 4% number that we would start to worry about. Nonetheless, we have turned. And so from here, it seems easier to get those type of tightening scares because you now have a wage series that looks like it's suggesting you're at the point where you're getting a bit more labor market tightness. Not that the labor market is tight, but that you are at an inflection point here. I would also say I think this helps address the labor force participation issue. There are 3 main views of the labor market that I would give you. One is based on short-term unemployment versus long-term unemployment. If you take just the short-term unemployment rate, the labor market's starting to look tight. Now that seems too extreme because this number is 2, not 4. So if the labor market were really as tight as the short-term unemployment rate we're suggesting, perhaps we would see faster wage growth like we did in a more mature part of the business cycle. The other side of this argument is labor force participation has fallen so much, maybe there's massive excess slack in the labor market. But the labor force participation rate, if you look at demographics, doesn't look that far off. And so I don't like statements that say, well, if we had kept labor force participation back where it was several years ago, maybe the unemployment rate would be 10 or something of that sort. That also seems too extreme because this series is going up. So the way I think we can square these facts to say perhaps the unemployment rate and the labor force participation rate are about right. They're slack in the labor market because the unemployment rate is 6.3, not 5.5. But we have hit a point where it looks like you're entering the second half of the business cycle. That's a part of the business cycle where labor takes share, where the labor share of GDP starts to rise, where cost cutting stops working. And so here's some evidence that we've hit that point, consistent with other second halves of the business cycle, such as the mid-'80s, the mid-'90s, and the mid-2000s. What this also makes very important is what our productivity numbers start to look like. So the first quarter number was a disaster, and that's not surprising because we had flat GDP and employment gains. So that does not look like a very productive quarter. The reason that's important is the way you can pay higher wages is through productivity. In other words, the first half of the business cycle where labor is weakening, you could argue you can cost cut your way to success. The second half of the business cycle is a point where you have to pay labor and capital together. In other words, that story doesn't work anymore. And so we've succeeded in several episodes of doing this. So if you look at the 1980s, wage growth was able to accelerate, and you did okay on profits, I would argue, because in part you had a lot of financial innovation. In the 1990s, you had a lot of tech innovation. Now in 2006, you had a lot of investment, but it was in unproductive real estate. So I'm not talking about the amount of assets, but the utilization of assets. And if you have strong productivity, you get longer cycles. If you have weaker productivity, you get shorter cycles. And that's why I think what this is telling us is to focus on those productivity data, because if we're not going to get productivity gains, we're going to start worrying about rising wages. We're going to have more of these inflation stories that are going to come up in the next year, moving towards a tightening in the market. And so even if we have less inflation, we could have more inflation scares because of the anchoring problem. In other words, because we are starting at zero, we have pushed the central bank and perceptions of the central bank all the way to the dovish side. In other words, I think it would be hard to see what you could credibly do to get more dovish if you were the Fed, let's say. What could you say? If you can't use forward guidance because you've already given it, if you can't do more QE because you're tapering and you can't cut interest rates, it's hard to see how you get more dovish. And so with wage growth heading higher, consistent with the second half of the business cycle, and a heavily momentum-driven series, meaning once it starts, it doesn't tend to stop, we think we're set up for a position where you're looking at the possibility of an inflation scare over the next year. Or maybe I'll end with this comment. It seems there are three things that are happening right now that can't all be right. One is economists have growth forecasts up at around 3% real GDP. So let's say that's going to get you close to 5% nominal growth. The Fed is giving guidance that says we could be tightening in 2015. And then the bond market's sitting there with the 10-year Treasury at 2.6%. So 5% nominal growth, Fed tightening, and 2.6% 10-year Treasuries don't seem to match. Something there has to give. And that's where we think there will have to be a tightening in the next year. Maybe it's the bond market, not the Fed. Those two can interplay. Maybe the Fed can react to financial developments, as they said they would. But sometime in the next year, that set of three items, growth forecasts, the bond market, and the Fed, have to square. Thank you.
So I'd like to thank our opening panel for 4 excellent presentations. I'm going to throw it open to questions now. Again, we are recording, so please wait for Jill to bring the microphone to you before you ask your question. And we've got a fair amount of time here. We've got about 25 minutes for questions, so ask tough ones that they can expound on. Let's start with John Calvary here in the front.
Sure. Is this on?
Yep.
Yeah. John Calverley, Standard Chartered Bank. Well, first of all, thanks for some excellent presentations, very thoughtful and I think very complementary to different aspects. I'd like to push you to look a bit more forward, and in particular, look at this question of what do we mean by normal interest rates going forward. The Fed's dot chart talks about 4% as being kind of normal. Janet Yellen yesterday said that we might not go back there for a long time, but it's still sticking, I think, to the idea that there is something called normal, and it is around 4%. Bill Gross has said perhaps 2% is going to be the normal rate for interest rates going forward. And I just wondered if the panel has their own views on this.
Well, so we're a participant in filling in those long-term projections that the FOMC releases, or released after the meeting quarterly. So I can tell you what we wrote down, 4%. Is there a good reason for writing down 4? No. I mean, there's in the back of our mind a back of the envelope calculation that long-term real rates are somewhere around 2%. We'll hit the 2% inflation target, and those things together give you about 4%. What is conveniently left out, and so I don't think that that's unreasonable. What's conveniently left out is what long run means, and that's where the comments of Chairwoman Yellen sort of come into play, which is what is the trajectory towards that 4%. And we're going to be wrong about 4%. I think probably in the end, the deeper question, or the more difficult question for us is, what's the steepness of the path towards wherever it is we settle. Right now, presumption is it's pretty shallow, and there will be plenty of time to figure out what that resting point would be. But of course, if that turns out to be wrong, we've got a bigger problem on our hands than right now we're probably contemplating.
I just add one follow-up comment, which is it seems there are two ways you could miss the 4, which is you miss the inflation target or you miss the real growth target. So it's hard to see how you miss the inflation target in the long run, given that you have a tool that at least seems to prevent deflation. In other words, it looks to me like you're going to look back on this period in history and write about it as the time when we figured out we don't have to have deflation if we do QE. Where there is a tool that seems to at least prevent deflation. And we can debate how it works, and that might go on for longer than this session. But it seems that in the long run, you can be pretty sure you can get at least close to the inflation target. Maybe the inflation target should be a different number. I think that's also debatable. Then on the real growth side, the big swing factor is probably productivity. We pretty much know what's happening with population growth, which is you're losing a couple tenths off that. But we've had trend productivity look like it's 3%, and we've had trend productivity look like it's 1%, depending on which decade we look at. And really, since about 2004, 2005, productivity growth hasn't looked that good. And so I think one of the bigger questions is, are we at a point where productivity growth is exhausted? And there are some folks making that argument. Are they right? Is Bob Gordon right? Or is Tyler Cohen right? Is that type of argument correct, that productivity growth is exhausted? Because I think that'll impact the long-term real interest rate.
Yeah, I would just nod back to what Dan said earlier, and my choice would be that we were the ones that were in control of the reins at the time. In other words, that it's us who are behind the rise in rates and not the market deciding on our behalf. And I think that that's where the risk lies right now.
I mean, the perspective that I would put on this is that globalization plays a really important role in both the F prime of K and the productivity, which is the real side, and also on the inflation side. The extent to which global forces put downward pressure or upward pressure on price inflation and labor market inflation are both really important. But I think we also have to recognize that the inflation rate that that we have been focusing on is the inflation rate on the real side of the economy. In other words, coming from tightness in labor and product markets, inflation expectations, and maybe commodities. That's kind of a standard Keynesian strategy for looking at inflation. But that increasingly, and this is not a new idea, but increasingly whether or not we should be focusing on assets explicitly in our inflation target is a question that has come up. Particularly, the BIS has been focusing on this extensively, calling it the financial cycle as opposed to the business cycle. And so it says that the marrying of these two, sort of 2% on inflation and 2% on technology, the role of the asset markets in creating either a positive dynamic between those two or a negative dynamic between those two components of our 4% normal. I think that's something that we have to pay a lot of attention to, because the financial markets or the asset side could lead to a long period of deviation between the two components that we want to pay attention to, and the role of the asset markets, the foreign players, and ourselves operating through the foreign markets, our own investors operating through the foreign markets, are potentially a wild card.
Katarzyna Zajdel-Kurowska, National Bank of Poland. I would like to thank for brilliant presentations, very thoughtful. But given that monetary policy and the currency issues in 2014 is the title of our seminar today, I would like to ask you for your outlook or your thoughts about the dollar, because you commented only on monetary policy, and it looks like this is like the most relevant. But for outsiders, I mean, all countries outside U.S. also dollar trend is extremely important. So I would like to ask you I would like to ask you two questions. First, whether the dollar outlook is irrelevant for monetary policy in-house, or whether there is any implication of the monetary policy for the dollar behavior going forward, and what would be the impact of the dollar, of the weak dollar, or maybe if you have other projections for the path of the dollar, like appreciation, what would be the impact on GDP outlook going forward? Thank you.
So members of the Federal Reserve are beholden by law to note that dollar policy belongs to the Treasury and not the Fed. To the question, is it irrelevant? The answer to that is no, in the following sense. Disorderly markets are disorderly markets, and any time sort of any aspect of financial markets begin to behave in ways that are appearing to be detrimental to stability of the real economy, we start paying attention. Traditionally, I mean, I've been in the Fed for, 23 years or something like that. The dollar per se has never been a focus, in my experience, of U.S. monetary policy, to the extent that movements in the dollar have become relevant for broader macroeconomic objectives, then the responses are traditional macroeconomic type responses. And I think that's been the flavor of policy basically forever within the Fed, and remains the kind of flavor of policy today. So if it's all orderly, then the markets take it where it takes it, and we stick to our knitting.
The gentleman to my left has got 14 years seniority on me, and I'm going to stick with his answer. Thank you.
I would like to make the following observation about the trade-weighted dollar. Since I'm no longer with the Federal Reserve, I don't have to accede to their communication standards. First, you know, there are two big cycles for the dollar in the 80s and then in the 2000s. And if we just take away those two big cycles, then the rest of the time, the trade-weighted dollar porpoises with the euro or the previous euro individual currencies. And by porpoising, I mean it kind of goes up and down, and maybe there's a variation of about 10% here and there. But you know, there's just not a lot of action, and we're in that period right now. It kind of has a base to it, and you know, I'm not a chartist, but if you were a chartist, you know, you can draw a line and take the Federal Reserve's trade-weighted dollar, and you can draw a line at the bottom, and it never really goes below that line. And right now, it's above that. It's in an appreciation phase of this porpoising of about 10% back and forth. So you have to ask the question, what would put us in a position that would get us out of this porpoising, some sort of either financial market view that there should be a financial market underpinning of a big appreciation phase or not, and what are the implications of anything like that for emerging markets? And there is an interesting potential structural underpinning for what might be an appreciation phase of the dollar. And that is that, as I alluded to in my presentation, what appears to be a breakdown of the elastic relationship between the import of goods and services in the United States and GDP growth. It's most extensively observed in consumer goods, but across the board. You know, there does appear to be this breakdown in the elasticity of imports with respect to economic activity. Now, what that has a number of different implications. If it represents a structural change, and it could be due to our energy costs, it could be due to income disparities, that, you know, there's a lot of people who aren't very well off, continue to not be very well off, and so they're not buying all that stuff at Walmart anymore. You know, one of the implications of that is that the United States has a smaller trade deficit going forward than it would normally be the case when growth normalizes to, you know, whenever it does, to 3%. Our trade deficit will be much smaller, will not widen. Now that is a good thing from the standpoint of underpinning an appreciation of the dollar. You know, in particular, that would be further bolstered if the interest rates go back to a normal 4%. Now, it's bad for the emerging markets to the extent that those countries who thought that the U.S. market was going to be their driver of economic growth, it will not be there. You know, the period of time when foreign producers could depend on a nominal market expansion of their product of, say, 10% growth rate times this elasticity, it's just not going to be there. And so the process of economic development of emerging markets, those in particular who are planning to take over from China, are really going to have a significant problem. They're also going to be having to deal with potential inflationary consequences of a depreciation of their currencies as they try to compete for the U.S. market. And so as the process, as we move towards a more normal stance, could have both a disruption as you know, capital flows out of the emerging markets, and not have an economic growth benefit for them. And I think that's a problem that the Federal Reserve is not going to consider, but there ought to be at least acknowledgement that that problem exists.
Hi, it's Elena Moya with Legg Mason, and you've highlighted like very serious and major problems threatening the U.S. economy. Do you see a turnaround, or do you see this to stagnate the U.S. for a few years? And we saw how China is supposed to be overtaking the U.S. economy this year, according to a think tank, you know, as early as 2014. Do you see that gap widening and the U.S. slowing down and becoming a further number two? Or do you think that the position of the U.S. as the main driver of world growth will not be threatened ultimately?
Well, again, I'll take a first stab at this, and again, I see the world very much through the financial markets, and my greatest concern is that the market cycle has become the predominant force in our economy, even though the wealth effect has been much less effective in assisting the entire population, if you will. So I think the biggest risk to the U.S. economy is that because the financial markets themselves have become so much more volatile in this era of monetary easing, that it places us in a much more vulnerable position. One of the last things I spoke about, however, was pensions, and it's kind of the newest area of where I've shifted my focus to, because it effectively takes away some of the power of the Federal Reserve in trying to temper animal spirits, because you have a separate, completely outside force of cash moving into the credit market. So even if we wanted to try at this point to try and take away that punch bowl, there's something that's acting as a governor on our ability to do that. So I think the financial markets are one of the primary risks going forward.
So I find it very difficult to tell a 3% GDP growth story for 2014. And I was having problems telling that story even before Q1 came out, because I don't see the capital investment coming on that would warrant job creation, even though, yes, I do see jobs out there. I'm not going to deny that there are, jobs being created, but I don't see that those translate into the capital investment or generate the demand that will lead to the capital investment that will support the economy in the longer term. And so does that mean I see recession? No, I see that this sort of the stumbling along at 2.25, that will, enter a period of time where something, where Europe was, maybe we'll be back, I don't know. I mean, it represents the advanced economies not being the driver of global growth. The problem is that the developing economies have not been able to move towards a domestic demand-led growth phase. And yes, we all hear about the billions of the middle class, but they just don't buy as much. The middle-class person in Brazil or in Indonesia, even though there are many more of them, are not driving global growth. And with all due respect to McKinsey and everybody else who uses those arguments, the domestic demand-led growth from the emerging market is not a driver of global growth of the kind where we would see 6%, 7% global growth, which everybody sort of really wants to see as supportive of rising living standards. And as for China being bigger than the U.S., PPP, we all have fun with PPP as a calculation, but China, I'm not a China bull, and I think they're going to have a really nasty financial credit problem.
We do know that the long-term growth rate of the United States is going to slow down strictly out of demographics. So that's in the cards. Whether or not we can eventually make that up either by changing immigration policy or something of that sort, or through productivity gains that we don't see the source of quite yet, remains to be seen. But I sort of want to follow up on points that have been alluded to earlier, and kind of Catherine's comment about investment. So I'll make a bold statement. Interest rates are not low in the United States because of the Fed. They aren't. Businesses aren't failing to invest in real productive capital because of some promise that the overnight interest rate is going to remain low for another 12 months. To me, those things just sort of defy common sense. Interest rates are low because globally there's not much demand for capital expenditure. Now, once we figure out why that is, then the dynamism of the U.S. economy, the dynamism of the global economy will be something that we can talk about as a real imminent event. I'm sticking to 3%, but it's not because I think 3% is good. I mean, 3% is pretty darn modest in the context of the whole from the crisis. And there is some deep structural issue, not just in the United States, but in the global economy that I don't think we've cracked. And too often we get tied up in, in this debate about when will QE end, when will HAPER end, when will interest rates drop. It's all a little bit second order, more than a little bit second order, to these bigger questions about what in the heck is going on and why can't we get businesses to want to buy a machine rather than to restructure their balance sheet.
I might just add one wrinkle to this is even if the structural stagnation story, as it's been called, is correct, I'm not sure we're going to know that in the next few quarters anyway. In other words, it does look like there's some pent-up demand where you'll get a bounce back after a very weak first quarter. So I think the risk might be in the very near term that growth looks stronger, not weaker. It would certainly be new information if you don't get that bounce back. That would be important.
And one last question from the back.
Yep. The market focus at the moment is very much on Fed tapering and the potential timing of the next rate hike. But Janet Yellen has been taking great pains to stress how the path of rates and policy is not on a preset course. So I'd like the panel's view on what would it take in terms of the data, labour market, inflation, and growth for policy to get looser. And as part of that, I'd also be interested in the panel's view as to if that were to happen, what that looseness might look like. In other words, would it just be a reversal of tapering, or would it be something else?
My own view would be, and I stress it's my own view, a failure of wage growth to pick up, and we watch in addition to the chart on average hourly wages, like the broader measures like the employment cost index, which are still absolutely flat. If inflation remains sub 1.5% on kind of a year-over-year basis and showing no sign of budging, and some of these broader issues in labor markets, such as the long-term unemployment rate, part-time for economic reasons, all the sort of symptoms of deeper weakness in the labor market, if those things persist, then policy will remain on an accommodative course. I think my comments probably suggested that I don't think I'm not a, I give my boss advice about what to do if we see such circumstances. My personal advice would be, let's not be so quick to pull another round of QE out of the closet. As I suggested, I think of QE3 as sort of that booster shot to the credibility necessary at the time to implement forward guidance. But we've shown disagree a little bit with some of the earlier comments. I think we can extend out that forward guidance. We've done it in the past. It did what it was supposed to do, which is alter market expectations about the trajectory. And right now, that looks like the logical course, which is to simply say, well, maybe it's not mid to late 2015, maybe we're into 2016 before it feels like time to pull the trigger. And that would be my advice to my boss at the time, not knowing what those circumstances are going to exactly look like, but if they look like I pose, I think that would be the direction to go.
So I would add a very technical aspect to what was just said, and that's that on a practical level, as of the end of April, we were buying approximately 90% of mortgage-backed securities on a net basis. And I would add to what Catherine spoke to earlier about the crowding out in the Treasury market. So in a technical sense, we've started to see the markets push back a little bit against what some of our traditional QE tools have been. So I can never look into the future and see what a new iteration of credit easing would look like, but I would suggest that the market is telling us that it would not exactly be the same the next time out.
I might just go back to the list of 3 tools. So you can't cut interest rates. The QE, for the reasons mentioned here, looks exhausted. So you may be left with forward guidance. I guess I might say that it seems less effective than you might like. If you're already forward guiding a year, it may be tough to implement that.
So one of the consequences of moving, one of the reasons why the tapering is being undertaken is because the costs, as outlined in the Bernanke speech, those costs have been elevated and the benefits have diminished of the policy stance. That's why I think that speech is a very important one, because it laid out the way the economists, we think about costs, benefit. When the costs rise and the benefits diminish, that's time to change your strategy. Now, I think it is important to recall that our policy has had these 2 components of purchases. One is mortgages and one is U.S. Treasuries. I tried to outline that I thought that the disruptions, especially on the foreign side, on the U.S. Treasury market, were really pretty severe. And the benefits of supportive asset markets were really very narrowly focused on a very narrow population, those who hold financial wealth. On the other hand, mortgages potentially have a broader base of benefit to the economy, in that home ownership rates are 60%, whereas that is not true for holding financial assets. Now, the problem with maintaining mortgage-backed security purchases while also tapering or continuing to taper U.S. Treasuries, because you're disrupting that market too much, and the benefits you're getting through the asset channel are really pretty limited. The problem is that who is purchasing the housing at this point is not, as it was pointed out, it's not kind of like, Mary Smith, who's 27 years old. It is BlackRock. Yeah. So the Federal Reserve is basically, through its mortgage-backed security purchases, is kind of transferring, risk from BlackRock onto its own balance sheet, and that's where the cash purchases are coming from, and that's who's getting the benefit of the program. So on the one hand, I would have liked to see a broader-based mortgage-backed security continue on, because its potential for supporting a broader swath of the U.S. economy through an appreciation in their housing prices, that's kind of been cut short, because who's gone off and bought all of these houses is kind of, as I say, not Mary Smith. And so as much as I wanted to see mortgage-backed securities play a pretty more major role in the program, short of really doing something like changing the conforming mortgage requirements so that you can get a mortgage for more than changing the conforming requirements, changing FICO scores, changing the way the whole mortgage market works, which is really getting deep into intervention.
I'd like to thank our opening panel. I'd give them all a round of applause. And I'd like to thank them as moderator, because we kept pretty much on schedule. So we'll be back here in about 10 minutes at 11 o'clock, take a short coffee break, and then we'll come back on the international or the domestic European front. Thank you.